macro currency signals.
This is not about hype. This is not about speculation. This is about positioning yourself before a monetary shift that most people won't recognize until it's too late. You don't need 100 kilos. You don't need a vault in Switzerland. You need 1 kilo of silver. And here are the reasons why. For nearly 80 years, the global monetary system has rested on one central pillar: confidence in the US dollar. After World War II, the world needed stability, and America provided it. The dollar was first backed by gold, and even after that link was severed, it was backed by something just as powerful at the time: trust. Trust in American productivity, trust in its military strength, trust in its political stability, trust in its deep and liquid bond markets. But here is the truth history teaches us over and over again. Trust is not permanent. It must be earned continuously. And when fiscal discipline erodes, when debt expands faster than real economic output, when deficits become a permanent feature instead of a temporary tool, that trust begins to weaken. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. Now, let's come back to what just happened. Today, global debt levels are not just high, they are historically extreme. The reserve currency status of the dollar has allowed the United States to borrow cheaply and finance consumption for decades. But reserve status is not a gift, it is a responsibility. It requires stability, credibility, and long-term purchasing power. When foreign nations hold your currency as savings, they are holding your promises. And if they begin to question the durability of those promises, they do not make speeches about it. They adjust their portfolios, quietly, strategically, gradually at first, and then all at once. Across emerging markets and developing economies, central banks have been increasing their gold reserves at the fastest pace seen in generations. This is not nostalgia. It is not symbolic. It is a calculated move toward neutral collateral. Gold carries no counterparty risk. It cannot be printed. It cannot be sanctioned. It does not rely on a foreign government's policy decisions. In a world where financial systems have become tools of geopolitical leverage, neutrality becomes extremely valuable. When nations witness reserves frozen or payment systems restricted, they draw conclusions. They diversify away from single points of failure. Gold becomes insurance at the sovereign level. As trust in fiat systems becomes more conditional, gold begins transitioning from a passive reserve asset to an active monetary stabilizer. And when that transition occurs, price must adjust. The current valuation of gold reflects a system where it is optional. But if gold starts absorbing a greater share of global monetary liabilities, if it begins functioning as collateral for trade and settlement between nations that want independence from dollar-based rails, then it cannot remain priced as a fringe asset. It must revalue higher to balance the scale of global money supply. This is how monetary shifts unfold. They rarely announce themselves clearly. They build beneath the surface. Bond markets wobble. Currency volatility rises, nations reposition quietly, and then suddenly the market realizes that something foundational has changed. When gold moves in response to systemic stress, it does not move slowly, it reprices in steps, and when it does, silver historically follows with amplified force, because silver is smaller, thinner, more volatile. It carries both monetary and industrial demand. When confidence shifts, silver becomes the pressure valve. What we are witnessing is not random fluctuation. It is structural realignment. The global system is preparing for a future where trust alone is not enough. Hard assets are being repositioned as anchors. And when anchors are pulled back into a drifting system, the repricing that follows is rarely subtle. When you step back and look at the broader policy direction, you begin to see something bigger than headlines or campaign rhetoric. You see a shift in posture. The message coming out of Washington is not subtle anymore. It's about sovereignty. It's about control. It's about reducing dependence on global supply chains that can be disrupted overnight. For decades, the United States leaned heavily into globalization, outsourcing production, importing cheaper goods, exporting financial assets. That model boosted corporate profits, strengthened the dollar, and hollowed out domestic manufacturing at the same time. It made Wall Street stronger, but Main Street weaker. And now the realization has set in. You cannot remain an economic superpower if you do not produce critical goods yourself. Reshoring manufacturing is not just an economic choice, it's a strategic one. When supply chains stretch across oceans and pass through geopolitical rivals, they become vulnerabilities. Microchips, pharmaceuticals, energy infrastructure, military components, these are not optional luxuries. They are national security pillars. Bringing production back home requires investment, incentives, and in many cases, a weaker currency. because a strong reserve currency makes exports expensive and imports cheap. That dynamic benefits consumers in the short term, but erodes industrial capacity over time. If the goal is to revive domestic production, the currency cannot remain perpetually overvalued relative to real assets. This is where the idea of a reset begins to make sense. Not a dramatic overnight collapse, but a deliberate repositioning, a recalibration of trade relationships, a willingness to challenge long-standing global arrangements in favor of bilateral leverage, tariffs, strategic resource discussions, energy independence initiatives. These are not isolated policies. They are components of a broader shift away from global integration toward controlled self-reliance. Whether one agrees with the politics is secondary. The economic implications are what matter. When a nation prioritizes internal strength over global accommodation, monetary dynamics change. In a globalized system, the reserve currency must remain stable and widely accepted. In a sovereignty-focused system, the priority shifts toward competitiveness and resilience. That often means allowing hard assets to appreciate relative to currency. Gold thrives in environments where confidence in fiat systems becomes conditional. Silver thrives when industrial expansion and monetary stress collide. If the objective is to rebuild manufacturing, secure supply chains, and reduce exposure to foreign creditors, then tangible assets become strategically important again. A nation repositioning itself for long-term durability cannot rely solely on financial engineering. At the same time, fiscal realities loom large. Servicing massive debt loads in a high-rate environment is unsustainable over long horizons. Policymakers historically resolve this tension in one of three ways: growth, inflation, or restructuring. Growth requires productivity. Inflation reduces the real burden of debt. Restructuring damages credibility. In a reshoring environment, controlled inflation through currency debasement becomes politically easier to justify than outright default. And when inflation accelerates, capital rotates towards stores of value. This is why silver sits quietly in the background of this transformation. It is not just a commodity. It is a monetary metal with industrial utility. If policy direction favors domestic production and tolerates currency softening, silver benefits from both sides. Industrial demand rises with manufacturing. Monetary demand rises with inflation expectations. The intersection of those forces is powerful. And when governments begin prioritizing sovereignty over globalization, markets eventually follow the signal. Silver is one of the most misunderstood assets in the entire financial system. Most people think of it as a cheaper version of gold, a secondary precious metal, something you buy only after you've accumulated enough capital to afford the real monetary metal. But that perspective misses what silver actually is. Silver is not just money, it is infrastructure. It is embedded in the circuitry of modern civilization. It sits inside the devices we depend on, the energy systems we are transitioning toward, and the defense technologies that underpin national security. When you hold silver, you are not just holding a hedge, you are holding a material that the modern world physically consumes. Every solar panel requires silver. Every advanced semiconductor relies on silver's unmatched conductivity. Every electric vehicle, every 5G tower, every data center powering artificial intelligence systems, they all depend on silver. It is the most electrically conductive metal on Earth. It is highly reflective. It is antibacterial. It is irreplaceable in many of its applications because substitutes either perform worse or cost more in the long run. That makes silver unique among monetary metals. Gold is hoarded. Silver is used up. Gold largely sits in vaults. Silver disappears into industrial supply chains, often in amounts too small to recycle economically. That creates a constant drain on available above-ground inventory. Now think about the scale of the global energy transition. Governments are pouring trillions into renewable energy infrastructure. Solar capacity continues expanding at record rates. Each incremental percentage increase in solar adoption pulls millions of additional ounces of silver into permanent industrial use. Meanwhile, many primary silver mines are aging. Grades are declining. New discoveries are scarce. A significant portion of silver production comes as a byproduct of mining other metals like copper and zinc. That means supply is not entirely responsive to silver's price alone. Even if silver doubles, it does not automatically double supply. Production depends on broader mining economics. This imbalance between structural industrial demand and constrained supply is not fully reflected in the current price. Markets often focus on short-term fluctuations, currency strength, interest rates, speculative flows, but beneath those cycles, industrial demand remains steady and, in many cases, rising. When monetary stress layers on top of that industrial baseline, the equation changes dramatically. Because unlike other commodities, silver has a dual identity. In stable times, it behaves like an industrial metal. In uncertain times, it behaves like money. And when both identities activate simultaneously, price volatility accelerates. There is also the issue of above-ground stockpiles. Decades ago, governments held massive strategic silver reserves. Those reserves have largely been depleted. What remains above ground is fragmented. in private hands, industrial inventories, and exchange warehouses. The amount of truly available, investable physical silver is far smaller than the headline numbers suggest. If a meaningful percentage of global investors suddenly decided to allocate even a small portion of their portfolios to physical silver, the available float would tighten quickly. Silver sits at the crossroads of monetary transition and technological expansion. It is essential to the green economy narrative. It is essential to digital infrastructure. And it remains historically undervalued relative to gold. When a metal is both strategically necessary and monetarily sensitive, it does not remain ignored forever. It waits quietly until demand and scarcity converge. For decades, the silver market has not been a simple story of supply and demand. It has been a story of leverage, a story of paper contracts layered on top of limited physical inventory. Futures markets were originally designed for hedging, for miners and industrial users to lock in prices and manage risk. But over time, financial players began dominating volume. Contracts multiplied, leverage increased, and the amount of silver represented on paper began exceeding the amount of silver that could realistically be delivered. On major exchanges, a single ounce of physical silver can be represented by many times that amount in futures contracts. Most of these contracts are never settled with physical delivery. They are rolled forward or closed out in cash. As long as confidence remains high and most participants are content with cash settlement, the system functions smoothly. But the structure is inherently fractional. It assumes that only a small percentage of participants will ever demand the actual metal at the same time. The moment that assumption is challenged, stress begins to surface. When industrial users need physical supply, they cannot accept paper promises. A solar manufacturer cannot wire up a power grid with a futures contract. A defense contractor cannot build advanced guidance systems with a cash-settled derivative. They require metal, and when delivery requests increase while inventories decline, the leverage embedded in the paper market becomes visible. It does not matter how many contracts exist if the warehouse shelves are thinning. Historically, silver has experienced periods where the paper market lost temporary control over price discovery. In 1980, a combination of concentrated buying and limited supply caused a dramatic surge. In 2011, during the aftermath of financial crisis stimulus and rising inflation expectations, silver moved rapidly again. In both cases, corrections were sharp and emotionally intense, but the lesson was clear. When physical demand overwhelms leverage, price can move vertically, not gradually, not politely, violently. What makes the current environment different is the layering of industrial demand on top of monetary uncertainty. Deliveries in futures markets have increased in recent years. Inventories have tightened at various points. Refiners have reported extended wait times. Industrial consumption remains structurally strong. When you combine that with geopolitical tension and rising concerns about sovereign debt sustainability, the incentive to hold physical metal increases. Paper markets rely on confidence and settlement. They rely on participants believing that the system will function as expected, but confidence is fragile. If large players begin standing for delivery consistently rather than rolling contracts forward, the dynamic shifts. Each delivery removes inventory from the float. Each ounce taken off the market reduces flexibility. It does not require every participant to demand metal. It only requires enough to strain the margin. Silver's volatility is often criticized, but volatility is simply the market adjusting to imbalance. If years of synthetic supply have dampened price discovery, the eventual correction can overshoot to the upside. Bull markets in silver historically do not unfold in straight lines. They climb walls of skepticism, shake out weak hands with sharp pullbacks, and then accelerate unexpectedly. The key point is this: paper pricing can suppress volatility temporarily, but it cannot manufacture metal. When physical reality collides with leveraged structure, price does not negotiate, it revalues. When we talk about price targets for silver in 2026, we have to remove emotion and focus on structure. Markets are not random. They expand and contract based on liquidity, money supply, and relative valuation. Silver does not move in isolation. It moves in relationship to gold, to currency strength, to real interest rates, and to systemic stress. So if we're going to talk about where silver could go, we first have to ask a more important question. What happens to gold in a world of expanding debt and declining confidence? Historically, when gold reprices due to monetary stress, silver does not simply follow, it amplifies. The gold-to-silver ratio gives us a framework. At times of extreme fear, silver lags. At times of acceleration, the ratio compresses sharply. In 2011, silver reached roughly 3% of gold's price. In prior cycles, that compression was even more dramatic. So if gold were to rise meaningfully due to debt monetization, currency debasement, or global reserve diversification, silver's proportional move could be exponential relative to its starting point. Now consider the broader monetary backdrop. Money supply across major economies expanded aggressively over the past decade, especially following global crises. Even if expansion slows temporarily, the absolute base remains historically large. Debt servicing costs are rising. Governments face difficult choices: austerity, default, or inflation. Historically, inflation, the quiet erosion of purchasing power, has been the preferred path. If inflation expectations rise while real interest rates remain constrained, precious metals benefit. Gold responds first as a monetary anchor. Silver follows as the higher beta expression of that shift. Let's add industrial dynamics to the equation. Silver demand from renewable energy, electronics, and emerging technologies remains structurally firm. Supply growth is not accelerating at the same pace. When a metal experiences both monetary inflows and industrial pull simultaneously, price elasticity increases. Small imbalances create large price movements. That is why silver's historical rallies have been so intense and compressed in time. It does not grind upward slowly. It pauses, then surges. If gold were to reach significantly higher levels in response to systemic recalibration, whether that is gradual revaluation or sudden bond market stress, even a conservative gold-to-silver ratio suggests prices well above prior nominal highs. Adjusting past silver peaks for monetary expansion alone places the metal materially higher than where it trades today. That does not require panic. It requires mean reversion. Markets that remain suppressed relative to expanding liquidity eventually reconcile the difference. It is also important to understand that silver bull markets do not reward late positioning. They tend to move quickly, often surprising even experienced participants. Corrections occur, sometimes violently, but the overall trajectory during monetary transitions has historically been upward and sharp. The window of undervaluation does not remain open indefinitely. By 2026, the intersection of debt pressure, potential currency adjustment, industrial demand growth, and monetary realignment increases the probability of structural repricing. That does not mean a straight line, it means heightened volatility with upward bias. Silver has spent years consolidating beneath historical highs in a world where money supply expanded dramatically. When price eventually reconciles with that reality, the move is unlikely to be subtle. Now let's bring this down from the macro level to the personal level, because all of this, monetary shifts, sovereign repositioning, industrial demand, paper market stress, means nothing if it doesn't translate into action for the individual. And that's where the idea of owning just 1 kilo of silver becomes powerful. Not symbolic, not extreme, practical. A single kilo of silver is 32.15 troy ounces. It is substantial, but it is not unattainable. It does not require wealth. It requires intention. And that's important because most people wait for perfect clarity before acting. They wait for confirmation, they wait for headlines, they wait for everyone else to agree. But by the time silver is front page news, the asymmetric opportunity is gone. The revaluation has already begun. Owning 1 kilo is not about betting your future on a price target. It is about stepping outside the purely digital financial system and holding a tangible asset with no counterparty risk. A bank balance depends on the bank. A bond depends on the issuer. A stock depends on corporate performance and market confidence. Physical silver in your possession depends on none of those. It is not a promise. It is a thing. In times of stability, that distinction feels unnecessary. In times of stress, it becomes obvious. 1 kilo also represents accessibility. Gold is powerful, but for many people it feels financially distant. Silver allows participation at a lower threshold. It provides exposure to both monetary upside and industrial necessity. It sits at the intersection of inflation hedge and technological demand. And because silver is historically more volatile than gold, even modest allocations can create meaningful impact during repricing cycles. There is also a psychological dimension. Owning physical metal changes perspective. It introduces discipline. It encourages long-term thinking. You do not trade a kilo bar emotionally on a daily chart. You hold it as insurance. And insurance is not purchased because catastrophe is guaranteed. It is purchased because uncertainty exists. The global financial system today carries layers of uncertainty. Sovereign debt levels, geopolitical fragmentation, currency competition, technological disruption. None of these guarantee collapse, but they increase variability. 1 kilo is a line drawn in quiet preparation. It is a way of saying, if inflation accelerates, I am not fully exposed. If currency purchasing power erodes, I have a hedge. If silver reprices because of industrial shortage or monetary stress, I participate. It is not about fear, it is about resilience. Most importantly, you do not need to predict exact timing. Markets can remain irrational longer than expected. Price can correct before it advances. Volatility is part of silver's character. But position matters more than prediction. Owning 1 kilo means you are not chasing during a spike. You are already seated before the music changes. In a world built increasingly on leverage, derivatives, and digital entries on screens, holding a tangible monetary metal is a quiet act of diversification. Not dramatic, not extreme, strategic. And sometimes the difference between panic and calm during systemic stress is simply whether you prepared in advance or waited for permission.